Hey guys, welcome to another discussion about investing, one of my favorite topics. The topic I want to cover is net stocks, or at least that's what Benjamin Graham used to call it. If you're not familiar with the strategy, when Warren Buffett started out, his mentor, Benjamin Graham, taught him a strategy or one of the strategies was to buy net stocks, which is cheap stocks that are trading below liquidation value. And if you're not familiar, if you've never heard of it, I recommend you definitely look up the strategy. Very interesting, very fascinating. I'm not an expert in it, but the reason I'm bringing it up is because this one today just popped on my radar. I was doing some reading. A company called Arrival. And if you look today, in a single day, it is up 100%. A crazy move. And it wouldn't make sense normally because their news, I don't think, was that great. Heavily shorted EV startup Arrival surges to over 100% gain. But if you look at their accounting numbers, it does make sense. So I have below, might be hard to see, I have below some metrics, and we'll ignore these four metrics that I have. They are part of identifying cheap companies whose stock and market cap is so beat up that it's gone too far. Now, a company usually has assets and usually has value inside the company. Not always. Sometimes they have negative equity, but usually they have some positive equity. And rarely does the price and the market cap go below that. But this is what we're talking about. Net stocks work best when the markets are down, and right now, blah, blah, blah. Well, I don't want to go into the details, but let me just read one of the sentences. It's a value investing technique where the stock is valued purely on its current assets. In fact, Graham basically said that nets are stocks that are priced for liquidation. And this is very true. So let's jump over. We're going to ignore today's action. We're going to back up and just go before today's action. Like even yesterday, it was trading at 25 cents. And if we look at their current assets, not total assets, but the more liquid assets, $1 billion in assets, and total liabilities, both current and non-current, a little more than 500 million. So the working capital paying off liabilities was a positive number, and the market cap was 172 million. Now, if you do the math, there's almost 500 million in net equity, but the market cap was far below that. This should explain why a small company that's probably losing money pops 100%. Because if it went bankrupt today, there's more value in there than the market is giving it credit. So it should have been maybe 3 times higher, which means there's probably still a little bit left of upside. But every quarter, this company is going to probably burn cash. Let me see what so they have negative cash flow. Every quarter, that spread between the equity in the company and the liquidation value is going to shrink. So someone buying this for that pop needs to probably get out as soon as they can. But it's fascinating. Another company that meets the criteria. I have the EV list that I just made it up for this video. Another company that meets the criteria is CENN, Central Electric Group Limited. Now, I have to tell you, I'm not recommending any of these companies. They're super risky. It is for entertainment only. But this data is not up to date. I had to dig in their filings, and they're in a similar situation. I believe they're closer to 200 million with 139 million market cap. What that means is these companies are so beat up that they're trading worse than all the assets inside. And if they went, they're basically trading for bankruptcy. That's how bad the market is. And I believe that the drop in Tesla stock in the past, I mean, I guess it's the past year, from 400 and change to a little over $100, that drop in Tesla stock is making all the smaller, riskier companies less attractive. And there is a mass exodus out of the riskier companies. So much fear, maybe even tax loss selling, because that would also explain if you have a big loss in a company like ARVL and it's December, why not book the loss? And that would be the December effect. And then we'll have the January effect as people maybe reconsider what they sold after the 30-day wash sale rule. So very, very fascinating. While we're on the topic of risky, junky penny stocks, I want to bring up one that I always see getting a lot of attention, and I still don't see any reason for risking your hard-earned money. And this is one called MULN, because I've traded it before, and what I noticed is that they keep diluting investors, and I'll show that down here. If you look at MULN, this is their share count, and 3.8, 3.84, 4, 419, almost 5, over 5 million, and then boom, 498 million shares. You know what that means, right? They hurt investors, raised cash, but they don't even have sales, which really is unfortunate. I know some people that they argue that it's down the road, they're making acquisitions, of course they're going to burn money, but it doesn't seem right yet. If you look at the market cap, the market cap of MULN is almost at record highs, 648 million. However, the stock price is pointing down. How can that be? The market cap is at record highs, as seen by market cap down here, but the stock price isn't going up. It's the dilution. I don't think it's fair. I'm not a fan of this type of behavior because they could be trying to generate sales, trying to generate revenue, but if if they don't have profits and investors keep putting money up into the shares and the CEOs diluting, that seems like a robbery to me for all that risk. So I just thought this was a good opportunity to talk about different types of companies, different type of scenarios, all in one category, which is the EV space. Hope you found this useful, and if you have some comments to add, go ahead and share them in the video and keep the discussion going. Cheers.